Good day, and welcome to the interim results announcement call. Today's conference is being recorded. At this time, I would like to turn the conference over to Ben Habib, Chief Executive. Please go ahead, sir.
Thank you very much. Good morning, everyone. Thank you very much for attending our meeting on our interim results this morning. We have a little presentation which I believe is available to be seen on the internet, on our website, which you may wish to access while I go through the results, just so you've got the same pages in front of you that I have. For the purposes of this meeting, I'm taking it as read that anyone who is attending has shown enough interest in First Property Group to actually know what it is that we do. So I'm not going to go through what our business model is. I can take questions on the business model at the end if you like. But if you have now, by this stage, accessed our presentation, what I propose doing is starting on page 8 of that presentation and skipping the introductory pages. Page 8 sets out the highlights.
They can find the presentation under Media and News.
Okay, so if you're still searching around the website, it's under Media and News, a subheading called Media and News.
And there's a subheading under that called Presentation.
And then there's a subheading under that called Presentation, so it's deeply hidden.
2 levels down.
Okay, 2 levels down. Good luck finding it. So just starting on page 8, the highlights. A glance at the results will show you that actually it's been a terrific first half of the year. Revenue was up by just under 9% to £12 million. Statutory profit before tax was up 11% to just under £5 million. It's a shame we couldn't have rounded that up to 5. It would have been a nicer number to print, but that's as it is. Diluted earnings per share was 2.84 pence, which was was a larger increase compared to last year than the pre-tax profit was, as a result of a lower tax charge. And on the strength of these improved results, we have increased our interim dividend from 0.4 of a penny per share to 0.42 penny per share, which is an increase of 5%. As the exchange rate will indicate, against the euro, we had some favourable tailwinds carrying our profits forward during the first half, which I think amounted to just over £300,000 for the period as a result of the slightly stronger euro versus sterling. I'll come back to the composition of our profits and why the euro is important to us later in the presentation. On page 9, we set out very briefly a synopsis of the properties that we actually own. The book value of the properties we own is £146 million, and that's the value at which we carry them in the balance sheet. We don't mark to market our properties as long as their value exceeds the value at which we bought them, or their book value if they've been written down in the past. We therefore hold these properties in our balance sheet at £146 million. The market value is £172 million. So actually, our net assets per share 35.68 pence a share, whereas our adjusted net assets per share, taking into account these higher values, is just over 51 pence a share. So, as against our share price, we're kind of trading at or around net asset value based on these numbers. Cash balances that we held at the end of the period was 10 million, which was down by 4 million from last year, largely as a result of new investments we made this year of around 3.5 million in capital expenditure on the development of our shopping centre in Ostrowiec of around £1.7 million. So actually a reasonable cash level in view of investments and capex made. I suppose the real highlight of our first 6 months trading is that our assets under management rose by 37% from 400 million to 554 million, which is a very significant increase in a short period of time. And perhaps more importantly, third-party assets under management rose by 63% to just over £380 million during that period. As some of you may recall, during the course of the credit crunch, we swung away from being principally dominated by asset management towards being largely an owner of properties, and it's the swing back to assets under management that is important for us because we seek to be more of a fund manager than we do a property owner. Turning over to page 10, I will only cover points I haven't already discussed. Page 10 sets out actually all the points that I've already mentioned, with the exception of perhaps one point about which we're very proud, and that is that during the course of the credit crunch, a period when most property companies faced bankruptcy or did go bankrupt, actually we've managed to grow our net assets on an annualized basis of 26% per annum, which really is remarkable when you consider the sector in which we trade and the severity of the credit crunch to which we've all been subject. And then the other takeaways that I ought to mention, just looking at page 11, is that the weighted average unexpired fund management contract term is around 6 years. It's still a very good period that we have, clear vision on in terms of fund management income, and that we've got this new fund, FPROP Offices LP, that we raised in July this year, 182 million of equity, together with 80 million pounds of leverage if we so choose to, operate the fund on a leverage basis. So that gave us 260 million pounds of buying power, of which we've only invested 51 million. So we have a lot of headroom for the continued growth of our asset management business through the investment of the funds raised by FPROP Offices LP, and we would expect to be investing that money during the course of the next 18 months. Page 12 pictorially depicts what I've already told you, which is that net assets have grown strongly during the course of the credit crunch, and this is all without the help of any third-party investment in the group. We've done it entirely organically. And page 13, another graph of which we're proud, shows our dividend payout during the course of the last 14 years. In fact, that's our entire dividend-paying history of the company. And as you can see, whilst we had a slightly flatter trajectory to the growth in our dividend during the credit crunch years, actually we increased our dividend through that period, and we've been increasing it more rapidly since the credit crunch, the worst of the credit crunch abated. We take a positive and progressive attitude to the dividend, so as we grow our profits, we will go on increasing the dividend payout, and so shareholders, touch wood, can rely on a sort of healthy payout from the group going forward. Turning to segmental analysis, starting on page 15. As I mentioned, during the course of the credit crunch, we swung away from being an asset manager to being a property owner. It was quite difficult to raise third-party capital during the course of the credit crunch, and so we deployed our own capital to buy properties. As a result of those activities, which, by the way, were extremely well executed, even though I say it myself, we are predominantly a property owner at the moment, and so the vast bulk of our earnings come from property ownership. And you can see how that's manifested itself as between fund management fee income back in September 2014, when we were roughly split 50-50, and the year before that, in fact, we were predominantly asset management, to the very significant increases in profits coming from group properties, and the reduction in income coming from the asset management side. But as I mentioned, we've seen tremendous growth in our assets under management. We expect continued growth as a result of mandates we've already got, and we expect to secure new mandates, in the near to mid future. So we expect the grey part of this graph, the asset management fees, to grow in value, and also for asset management to become a more significant proportion of our overall profitability. We manage 12 funds, which, as I mentioned, currently add up to £382 million of assets under management. This is for third parties. Our funds are deployed in the UK, Poland, and Romania. We have an excellent track record. A fund manager really is only as good as their ability to raise their next fund, and so a good track record is important. We're rated as the best performing fund manager in Central and Eastern Europe by Morgan Stanley's index for the region, and we have achieved that accolade for every year that we've been operating in Central and Eastern Europe since 2005. We're FCA regulated and AIFMD approved, which means that we have the ability to raise capital from a number of sources and go widely for it if we need to, and people can rely on us to be managing to act as proper custodians of their capital, with these regulatory oversights and approvals in place. Page 17 to some extent sets out what I've already been through. It shows the reduction in asset management fees as we became more property ownership orientated, but with a backdrop of growing AUM over the last couple of years, which should come through to earnings as we go forward. Page 18 provides a split of the various funds that we manage according to fund, investor category, and geography. We used to be, just taking geography first, we used to be very, very Poland dominated. We're now more UK dominated by way of AUM, but it's important to recognize that the direct properties we own, and therefore the engine of the creation of the profits of First Property Group, actually come from the Polish properties. And so about 80-odd% of our earnings come from Poland, even though more than half of our AUM is in the UK. And it's just important to know that, because the earnings that we have in Poland are euro denominated, and it's those earnings that make the euro-sterling exchange rate important for us. And as a result of those earnings and the strengthening euro that we've had this positive contribution during the period which I mentioned earlier. The complexion of our funds come from ourselves, because that's, FPROP is a significant owner of properties that we manage. But the second largest, and I suppose we're proud of this as well, second largest constituent provider of capital are pension funds. Pension funds are generally good partners for fund managers because they're long-term, and at least in our case, we share an investment philosophy on how we drive returns out of property in terms of yield, etc. So we're pleased that we have a very significant pension fund client base. We also have a number of endowment funds, principally Oxbridge colleges. So we've got St Catherine's, Christchurch, and Robinson College, as well as Christ College, Cambridge, all as, the first two Oxford, the latter two are Cambridge, as clients. And we hope to secure more Oxbridge patronage as we go forward. We have a number of high net worth individuals who are long-standing clients of the group, and family offices. I'm not going to go through the fund breakdown by name, because there's a table at the back of this presentation which does it much better than I could do it verbally right now. Turning to group properties, so these are the properties that we own directly as well as non-controlling interests in 9 out of the 12 funds that we manage. We have about £172 million worth of property that we either directly own or consolidate into our balance sheet by virtue of owning the majority of FPROP Opportunities plc, a fund that we set up in 2010. A split of the way we earn our money from group properties, including FOP, but this is and excluding the non-controlling minority interests, is set out on page 21. And in view of the fact that the majority of our earnings come from the properties we own, it's worth just looking at page 21 in a little detail. So the net operating income that we earn from our properties was roughly steady at 9.41 million euros for the year to 30th September 2017. That's for the 6 months. Sorry, forgive me, there's an error in the presentation. That's for the 6 months to 30th September 2017. It's a slight reduction from last year because we sold a property in Romania. Interest expense down similarly as we amortize debt. Net operating income after interest expense of 7.82 million euros. Again, slightly down as a result of revenues being down. Current tax is slightly higher, but not materially so. Debt amortization is roughly at or around 3.66 million euros per annum. What? No, for the 6 months. Sorry, for the 6 months. And capital expenditure during the period was 2.1 million euros, which give us a free cash generation from the properties we own of 1.35 during the period. We had extra capex during the 6 months because of this extension that we were building at Ostrovic. That extension is now complete, and we will see the value of that extension coming through into our numbers going forward. The average yield that we earn on our properties is 9.6% per annum. That's the average yield based on market value. That's a very high yield. Some people look at the debt levels that we have in the group and question them. Well, we know the properties that we own. We've known them for much longer than we've owned them, and we're very confident in the sustainability of the revenue streams supporting the debt that is secured on these properties. So as a management team, we're very comfortable with the debt levels. The loan-to-value is 68%. This often is held out as a reason for people not giving our shares a higher valuation in the stock market, and I think that's completely bogus concern, largely, as I mentioned, because of the very high yield cover and long-term history we have of income coming off these properties. In addition, shareholders should note that each loan is secured independently on a property held in special purpose limited liability vehicles, so there can't be cross-contamination between companies, causing a sort of domino effect if one loan was to go sour. And you also ought to note that we have fixed the interest rate on around 40% of the debt that we have in the balance sheet, which gives us a good peg in the ground for any, albeit I don't think materially, I don't think interest rates are going to rise, but it gives us a good peg in the ground and hedge against interest rates rising. So we think the earnings coming off from these properties and the net cash contribution that they make to the group should continue quite comfortably going forward. We nevertheless wish to reduce our dependency on for profitability on properties we own. So we are growing our asset management side, as I mentioned, but we're also selling shares in FOP, which at the time that these results were struck was 67% owned by us. And we expect to reduce that to just over 50% in the near term, and maybe go below 50% in the medium term. That's the aim anyway. And once we deconsolidate FOP, you will see earnings, you see our balance sheet less bloated by properties we own, and you'll see a less leveraged balance sheet, and FOP will then be accounted for not as a consolidated entity, but as an entity which contributes associated income. So we'll just take our share of FOP's profits, as opposed to taking the whole lot into our balance sheet and profit and loss statement.
And of course, we'll be able to recognise fund management fees.
Yeah, at the moment, fund management fees levied on FOP are consolidated out of our numbers, but of course, we'll be able to recognise those once we deconsolidate FOP.
And the amounts are about £500,000 a year.
And then just to finish on page 21, the vacancy rate in our portfolio of properties we own is around 1.5%. It's been extremely low throughout the credit crunch. I'd expect it to remain low going forward, and it's that level of low vacancy which gives me the confidence in the income and therefore the profits that these properties generate. I think I've more or less covered page 22, so I'll skip that. Page 23 sets out the 10 most significant tenants in our portfolio. Most of these names are household names to the people in Europe, and all of them should be household names to people in Poland, with the exception of perhaps Aquila, which is a household name in Romania. So we have a fairly blue chip set of tenants. Just to explain for our UK and possibly US listeners, Asseco is the largest software company in Poland, Warsaw Stock Exchange listed. So we regard that as a blue chip covenant. Citibank is Citibank, Carrefour is Carrefour, Skanska is Skanska. We all know Tesco. Tenant number 6 is a government agency, a Polish government agency. We're a tenant in our own building, and we regard ourselves as extremely covenant worthy. Bank Zachodni WBK is a Polish bank. Aquila is the largest local distributor of goods in Romania, and HRK is an established recruitment agency, human resources provider of services in Poland. So 71% of our income comes from, very good blue chip covenants. Looking forward, Poland elected a populist right-wing government in October 2015, which caused a bit of eyebrow raising in Western Europe, and continues to exercise the European Commission's concern over interference with the judiciary and other slightly peculiar suggested economic policies that the party wanted to follow. But actually, a lot of what they said they would do that was perhaps more extreme they haven't done, and the Polish economy is trading extremely well at the moment. It's firing on all cylinders. Unemployment is down to record lows. Wage growth is rising. GDP growth rate is one of the best in Europe and being continually upgraded. Inflation is rising as a result of this, and we would expect to see genuine interest rate rises in Poland, which we see as a good thing because it shows that the economy is actually firing on all cylinders properly. And we may also, therefore, see the zloty strengthen against the euro, which would be very good for our properties because it means the burden that our tenants carry on paying euro rents would reduce, and we should be able to increase rents going forward, which would then in turn feed into values. So we see the Polish story as a very positive one. and we continue to be bulls of Poland, and we will continue to look to buy property in Poland, as and when we find the right deals. Turning over to Romania. Romania is a much smaller economy than Poland. It's a much smaller property market, but it shares a number of the same sort of big picture items, namely an enriching and then sort of continually getting, slightly tongue-tied, a population that's getting richer, consumer spending rising, GDP growth accelerating. Actually, the last set of numbers out of Romania were virtually in sort of overheating territory. 8.8% GDP growth rate, which surprised everyone, I think. And we would expect to see interest rate rises there as well. But occupier demand is relatively robust. There's been a lot of new development, as indeed there has been in Poland, which kind of keeps a lid on rent rises. But a very healthy picture for property investment, broadly speaking. And as with Poland, we're very keen to buy properties in Romania. It's harder to find them in Romania. It's harder to bridge the gap between buyer expectation and seller view of value. But we keep working on it. The UK has done extremely well for us. In the wake of the referendum for Brexit last year, we bought some properties cheaply when the market wobbled. In fact, we're selling one of those at a 35% increase in value since August last year in one of the funds, not a property we own, but in one of the funds we manage. And that's symptomatic, really, of the weakness in the market last year and some of the good deals that we did on behalf of our clients. There's continued political uncertainty and economic uncertainty in the UK as a result of Brexit and the weak showing of the Conservative Party in the recent elections. But we remain bullish of the UK, particularly because the institutions are sitting on their hands, and so we're able to buy larger lot sizes on historically fairly high yields, and that's where we're really looking at the moment for our offices fund. I know the OBR yesterday reduced its outlook for GDP growth of the United Kingdom, but the OBR is not known to be right. It's more often wrong than right, and we're pretty sanguine about their outlook. So we think the markets in which we operate are all doing well, and we're deploying capital in all of these markets. We continue to deploy capital judiciously, and I'm not certainly throwing caution to the wind, but we're basically bullish. So why would you buy shares in First Property Group? The reasons for it are all set out on page 28. I'm not going to go through them one by one, but broadly speaking, a very good track record, a strong balance sheet, reliable earnings, inbuilt growth through our fund management mandates, and no doubt, in my view, an ability to raise new mandates as we go forward and do new deals, all of which will be incremental to our profit. So I think our future is bright, and I hope shareholders agree. That eventually should come through into the share price and put smiles on our shareholders' faces. And I think at that point I'll open it up to questions. How do we do that?
Thank you.
Yeah.
If you would like to ask a question at this time, please press the star or asterisk key followed by the digit 1 on your telephone. Please ensure that the mute function on your telephone is switched off to allow your signal to reach our equipment, and a voice prompt on your line will indicate when your line is open to ask a question. Please state your name before posing your question. Again, please press star 1 to ask a question, and we'll pause for just a moment to allow everyone to signal.
Are there any questions in the room before we take any on the phone?
I'm interested to know what the relationship between the zloty and the euro has been in the last sort of 2 or 3 years. Has it been reasonably steady? Or?
Yeah, it's been the euro zloty exchange rate has been really very steady over the last 2 or 3 years.
Yeah.
And it's flipped between, I'm going by memory, so you need to test this, but I think flipped between 4.1 to 4.35, roughly, against the euro. And it's sitting at about 4.2 this morning. And all the commentary that I read, but again, commentary is most often wrong rather than right, but all the commentary I read is that the zloty should strengthen from this position in view of the strength of the Polish economy and the likelihood of interest rate rises going forward.
And the strength of the Polish economy, is that reflected in volume of transactions in terms of property, or is it new buildings?
Both.
Or offices?
Both. So transaction volumes for investment class property in Poland is running at around 4 billion euros a year, which is pretty much an all-time high. I think in 2007 it was around 4 billion as well.
But
maybe slightly higher. But there is a lot of new build in Poland. So, for example, if you know Warsaw, there's a place called Wola, which is on the western side of Warsaw. Warsaw has about 5 million square meters of modern office space. Wola alone is developing at the moment about 1 million square meters of office space. So there's going to be, an addition of 20% to Warsaw's office supply over the next couple of years. That won't show up in the turnover figures until it's sold.
Yeah.
The turnover figures are, what's bought and sold in the investment market. But they will feed into the investment market in due course.
Wola is V-O-L...
W-O-L-A. It's Wola, as we would pronounce it.
Yeah.
But it's Wola, it's pronounced in Poland.
But generally speaking, an appreciating zloty is good news for tenants because they pay rent in euros.
Yeah, sorry, you had a question.
Okay, yes. It seems to me that the real driver going forward is how quickly
Yeah. Yeah.
How quickly do you see the opportunity? How quickly do you think you can invest that?
Well, we're bidding. This doesn't really answer your question, but I'm going to say this anyway. We're bidding on enough property now to fully invest the cash commitment of 180. If we win all the bids for the properties on which we're bidding at the moment, we'll be fully invested from a cash perspective before Christmas. That won't happen. Some of those bids will be rejected. But we are seeing interesting property. And as I indicated, what's unusual is that some of those properties, actually the more interesting properties are really the larger lot sizes. Once you go north of 50 million now in the regions, and we're only in the regions, there are not many institutions playing, so we're not in a solo position, but we're in a pretty good position to pick up offices at nice yields and good prices in the regions.
That's what you're not seeing Europeans or US?
Not really, no, not really. Not in the regions. We're seeing a bit of foreign money, but not a lot. And, the Chancellor's step yesterday to tax capital gains made by overseas buyers of UK property, commercial property, I don't know if you saw that. That wasn't a wholly welcome move, obviously, for our sector.
Yeah.
The second question was on reducing your position in SPOT.
Yeah.
How quickly do you have a sort of idea of when you might get below the 50%?
Yeah, we have demand now for shares, which would take us, demand from buyers of shares in FOP, which would take us down to about just over 40%.
Tempered by a possible seller as well, which might take us, but whatever, I think it should take us below 50%.
Yeah, but that's just indicated demand, and again, like any deal, it's not a deal until it's signed. But we would expect certainly to be down to the low 50s very soon, and then to trickle down below 50 in the next 2 or 3 months. Deconsolidating it may not happen at below 50, because we may still be seen as a controlling party given our directorial representation on the board of the company. So we need to have a discussion with our auditors, but I suspect once we go below 40, then it's a pretty clear-cut deconsolidation. Do you agree with that, George?
Well, certainly when you're down to 40, definitely.
Yeah.
And Ben is right. Just because you go below 50 doesn't mean the same. You have to lose control of the company.
Which is what we have to do.
Yeah.
Yeah, to deconsolidate. Yeah, not lose control, but we've got to become. We can't.
Less dominant.
Less dominant. Yeah.
Exercising management control. Is that still the
Well, there is.
still the key phrase?
Absolutely, yes. And it's not dominated by a percentage.
Yeah.
And I think there's a new director coming on the board.
Yeah, there should be. If these sales go through, there may be a new director on the board as well, which is obviously helpful. Yeah.
So that's the sort of thing they look at. Or we should look at.
Any other questions? Are there any questions on the phone?
There are no questions in the telephone queue.
Okay. So I think then, without further ado, we'll bring matters to a close. Everyone's got my email address if they've got any other queries, and I look forward to reporting our final numbers in June next year. Thank you very much, everyone.
That will conclude today's conference call. Thank you for your participation, ladies and gentlemen. You may now disconnect.